So joining us now is George Hill from Deutsche Bank. He has a buy rating on the stock. George, it's great to have you on. And let's start right there, because this has been painted this week as the collapse of America's largest health insurer, at least from a stock perspective. Why would you buy now?
So, Morgan, first, thanks for having me. And I think if you look at United's business, United's business, broadly speaking, is pretty well managed. They've had a very difficult 2-year run in the Medicare Advantage business, both in the provider business and in the insurance business. They managed those two businesses a little bit separately. A lot of the headwinds in this business have been driven by the government providing lower payments to the insurer, as well as an increase in utilization that we've seen post-COVID. We think the company eventually moves past these headwinds, and this would seem to be an unusual time where the stock is trading at a valuation that's just, you don't often get the chance to buy United shares at 13 or 14 times earnings, given where the stock is historically traded. Simply speaking, we don't think the business is broken. We think these issues are manageable.
You know, it's interesting because you compare this, you use the analogy of General Electric, and I should say General Electric before it was spun out into 3 separate companies, which are now performing pretty well. But I was the reporter here at CNBC that was covering that implosion as it was happening over the course of years. So how are you comparing the two, and what are the lessons that we can learn from GE?
Yeah, it's an interesting question, and this, of course, kind of comes out of conversations with a lot of investors, and it's kind of the big if, right? History doesn't repeat itself, but it rhymes. And as investors were kind of worried at, what I would call peak fear on United Healthcare shares, the conversations that I had with investors were like, remember what happened to GE. Remember when they lost the ability to manage earnings. Remember when the financial business unraveled. Remember when the insurance business unraveled, and they lost investor confidence, and the company couldn't ever get back its premium multiple that it had versus its peer group. It could never kind of put the businesses back together, especially the finance business post the financial crisis. So we just kind of called that out as a cautionary tale, because United's actions over the last several years have looked a lot like GE's through that period. A lot of acquisitions. United has really plunged headfirst into the risk business, both in Medicare Advantage and in care delivery. At this inflection point, it's really important for investors to dig in and do they understand what United's exposure is to these risk business? Do they understand the impact of these acquisitions?
So, George,
yep, I'm sorry.
Paint the optimistic picture for us then, because you talked about the government having lower payments. I don't know that the government is looking to pay more anytime soon under the Trump administration. And then this increased utilization, people being sicker, I guess, even doing more outpatient. What is it demographically or adjustment-wise that UnitedHealth can do, especially under the broader cultural scrutiny that they face, to get ahead of that?
Yeah. So, John, the great news is we already have visibility to the higher payments. The government has already published what we call the rate notice for Medicare Advantage for the payment year of 2026. It's going to be up 5% and change. So after several years of flat rates, as utilization, to your point, continue to increase, United's going to get some relief next year as it relates to rates. The flip side, and this was what we think has been the big issue, we're going to talk a lot about risk. Beginning in 2024, the government changed the risk model. It basically changed the way Medicare beneficiaries are measured for how risky they are, and they started kind of lopping off these codes. It looked like a reimbursement cut if you're a UnitedHealth Group. The last year of the implementation of that is in 2026. You look back at the last several years, we've seen a big increase in utilization. Okay. We've seen a big increase in medical cost inflation. United should start to lap all of these things in 2027. So the blue sky.
Well, what quarter should investors expect to see the evidence this is happening?
I would expect to see on the Q4 Analyst Day and Investor Day this year, the guidance around 26 look better. I'd expect Q1 26 results to start to look better. And what we'll really be looking for is in January of 2026, the government will start to give us the look at what 2027 rates look like. That'll be that'll tell us whether we keep being pointed in the right direction or whether we're going to start to head in the wrong direction.